Welcome back to CEO Money. I'm Michael Yorba, your host. Thanks for joining us. All right, we've got Barbara Friedberg, Wealth Media LLC, and roboadvisorpros.com. Great, catchy website. All right, Barbara, welcome to the show. Thank you for being here.
Thanks so much for having me, Michael.
Tell us about yourself so the audience gets a chance to know who you are, and then let's talk about digital investment managers.
Sounds great. I'm a former portfolio manager for several decades. I've taught investments and corporate finance to university students, and I have 3 books: the Personal Finance Encyclopedia, How to Invest and Beat the Pros, and How to Get Rich Without Winning the Lottery. My current passion is digital or robo-investing, and I talk about that a lot on my top website, RoboAdvisor Pros.
All right. Tell us what digital managers do for those that don't know, and how it frees up time and helps people.
A digital investment manager or a robo-advisor creates your investment portfolio based on your own specific goals, timeline, horizon, and they do it with a computerized computerized algorithm. So what happens is you fill out a brief questionnaire, and then you are given an investment portfolio that meets your timeline and your risk tolerance. Fees for this service vary. And that's pretty much it.
That's not really pretty much it. I mean, you've got to set parameters because, the Securities Exchange is pretty stiff on, is this the right product for the risk profile? So you've got to program that in. How do you do that? I mean, normally humans have to make some kind of a judgment here within guidelines. How does that work where you just cut it loose? I mean, it can't be artificial intelligence, right?
No. The human aspect comes in at the beginning.
Okay.
Typically, most robo-advisors have a questionnaire that you fill out to determine how comfortable you are with losses in your portfolio. Because frankly, when you talk about risk, you don't care about the upward risk of making money. It's the downward risk.
Right.
So these questionnaires try and get at what are you going to do, how nuts are you going to go when your investments go down in value.
Today's a good example?
Yeah, today is a good example. If you are going to fall over, freak out, sell at any little drop in your investment value, then you're a conservative investor. If you can ride the ups and downs with pretty much confidence without, selling everything at the quickest drop, you may be a little more on the aggressive side. And then how much risk you can handle determines how much stock percentage you're going to have in your portfolio versus more conservative bond or fixed investments.
Okay, so you're dealing with your classic investor, not a market timer.
No.
Right?
In general, these are set it and forget it portfolios. Now, let me just give a caveat because within the broad robo-advisor field, there are distinctions and there are some players on the edges that do get into a little more of active management. But we're going to stick with your plain vanilla robo-advisors for now.
Okay. All right. And undoubtedly, you've got to back up the overall performance using this method versus the old-fashioned method of a human being involved from cradle to grave on this, right?
I didn't understand what you said. You've got a backup. I'm not sure I understand what you
No, you've got undoubtedly you look at the overall return of using machines instead of humans to be able to get that goal met or at least try to stay above the averages. That's what everybody's, I mean, when it comes to investors, they're looking at beat or stay above the averages. And what I'm getting from you is using robo-advisors gives you a better shot at that, and you probably got some kind of ROI that backs it up. They go, okay, if I'd have done this with you instead of Harry, I probably would have done better, right?
Okay, well, you brought up a really key point because the goal, what research has proven, Vanguard has done a lot of this research, as have academics across the sphere, is that investing in index funds which pretty much match the market, if you use that approach, you will beat 60 to 70% of active investment approaches. So wanting to beat the market is a great goal, but it's very, very low percentage shot. Very few people, very few advisors beat the market, and if they do, it is unlikely they will do that on a year-over-year basis. So in general, robo-advisors aren't seeking to beat the market. They are seeking to keep costs so low that you can get close to matching the market returns.
Okay. All right. We had to get that out on the table. All right. The state of FinTech and investing today.
Yes. And your question?
What is it? What is the state of FinTech and investing today?
Okay. Well, robo-advisors, digital investment advisors are becoming so popular today that what started with Betterment, probably the first robo-advisor several years ago, has now blossomed into over 20 or 30 or more individual platforms, gone from the individual companies such as Betterment, Wealthfront, Elevis, to now every major brokerage company is creating their own robo-advisor. So you'll see Fidelity Go, you will see Vanguard Robo-Advisor, Schwab Intelligent Portfolios. So what you're seeing in the industry is that the costs are lower when you use an automated investment advisor, and your returns are market matching in most cases. And so that's a good thing. So everyone wants to get in on the game.
Okay, the protection of principle is really what I'm getting here is first and foremost.
No, it is not protection of principle.
What is it?
It is growth of your money in line with your risk tolerance and goals. Protection of principle is pretty much investing in fixed assets like bonds or certificates of deposits. When you invest in stock assets, which are typically exchange-traded funds that will mirror a common index, you're looking to grow your wealth.
Keep going.
Okay. So with the popularity of robo-advisors in FinTech, what you're finding is that many human financial advisors are seeing the benefits of using a robo-advisor as well. So they're putting in robo-advisors in their back ends. And conversely, many digital or robo-advisors are seeing the benefits of human advisors, and they're including those in their investment offerings. So you're finding a hybridization of the industry that continues in growth and popularity.
Got it. We've got less than a minute left. Who is the appropriate investor for a robo-advisor?
I think it's someone that is willing to turn over their investments to an automated digital advisor and is comfortable with letting them do the heavy lifting. But really, almost anyone who has any level of assets can find an appropriate robo-advisor. For example,
Barbara, we don't need examples right now. We got a hard break, but thank you so much for being a guest on the show.
It was my pleasure. Thank you so much for having me, Michael. I really appreciate it.
You're welcome. Barbara Friedberg, Wealth Media, LLC, roboadvisorpros.com. Thanks for listening. CEO Money, Michael Yorba, and it's brought to you by Tycon Partners.